Investing in high-quality stocks has historically produced higher returns than most other investment options. This gives you the best opportunity to meet your financial objectives and reap the rewards of money working for you later. But what exactly are stocks? Hello, this is Flawless Finances, and in today's video, we'll go over a beginner's guide to investing in the stock market. But before we get started, please subscribe to the channel and switch on alerts to be notified of new videos. Let's talk about it. What exactly are stocks? A stock, often known as a share but also called an equity, is a financial instrument that reflects ownership in a firm or corporation and a proportionate claim on its assets and earnings. Stock ownership entails owning a piece of the company equal to the number of shares held as a percentage of outstanding shares. An individual or entity who holds 100,000 shares of a business with 1 million outstanding shares, for example, owns 10% of the company. The majority of firms have outstanding shares in millions or billions of dollars. Let us now discuss common and preferred stock. While there are two stock forms, common and preferred, the term equities refers to common shares because their aggregate market value and trading volume are many more than preferred shares. The main difference between the two is that common shares usually come with voting rights, allowing the common shareholder to vote at corporate meetings such as the annual general meeting (AGM), or on board of director election and auditor appointments, whereas preferred shares usually don't. Preferred shares have priority over common shares in receiving dividends and assets in the event of a company's insolvency. The voting rights of common stock can be divided into two categories. First, while the basic idea of common stock is that each share should have the same voting rights, one vote per share held, some corporations have dual or multiple classes of stock, each with separate voting rights. Class A shares, for example, may have 10 votes per share, but Class B subordinate voting shares may only have one vote per share under a dual class structure. Second, the founders of a firm can control its fortunes, strategic direction, and ability to innovate using dual or multiple class share arrangements. You may be wondering why a corporation issues stock. Today's corporations were most likely founded as a modest private company by a visionary entrepreneur a few decades ago. Consider Jack Ma's incubation of Alibaba Group Holding Limited, BABA, from his Hangzhou apartment in 1999, or Mark Zuckerberg's founding of Facebook Inc., FB, from his Harvard University dorm room in 2004. Within a few decades, technology behemoths like these have risen to become among the world's most powerful corporations. However, developing at such speed necessitates a tremendous infusion of cash. To go from an idea in an entrepreneur's head to a functioning business, they'll need to rent an office or factory, hire people, purchase equipment and raw materials, and set up a sales and distribution network, among other things. Depending on the size and breadth of the business, these resources will need a large amount of capital. Let's talk about raising capital now. A startup can either sell shares or borrow money to raise finance. Debt finance can be difficult for a startup because it may have a few assets to pledge as collateral for a loan, especially in sectors like technology or biotechnology, where a company's tangible assets are limited, and the interest on the loan would be a financial burden in the early days, when the company may have no revenues or earnings. As a result, for most businesses in need of funding, equity financing is the best option. To get the firm off the ground, the entrepreneur may use personal savings and funding from friends and family. Then, as the company grows and more funding is needed, the entrepreneur may turn to angel investors and venture capital firms for help. Let's also talk about the listing shares. When a business is starting, it may require far more capital than it can acquire from ongoing operations or a standard bank loan. It can do so by selling stock to the general public in an initial public offering, IPO. This alters the company's status from a privately held company with a few shareholders to a publicly listed company with shares held by many members of the general public. The IPO also gives early investors in the company the option to cash out a portion of their interest, generally for a large profit. The price of the company's shares will fluctuate once they are listed on a stock market, and trading begins as investors and traders appraise and reassesses their inherent value. Various ratios and indicators may be used to value companies, but the price-earnings PE ratio is probably the most popular. Stock analysis is further divided into two categories: fundamental analysis and technical analysis. You might be wondering now how to invest in stocks and make money. Stocks are riskier than any other investments, but they also have bigger profit potential. Stock investors make money in two ways. 1. If the price of a stock rises during their ownership and they sell it for a higher price than they paid for it. And 2. Through dividends. Dividends are payments made to shareholders regularly. Not all equities pay dividends, but those that do are usually paid out every 3 months. The stock market has averaged a 10% annual return during the last century. The word average is crucial here. Not only is that return an average for the market as a whole rather than a single stock, but the market's return can be lower or higher than 10% in any one year. Individual stocks can be purchased using an internet broker. A brokerage account is open in the same way that a bank account is open. Because online brokers charge different commissions for stock trading, it's necessary to shop around. Hello there, buddy. I hope you've enjoyed this video so far. If you have, please remember to give it a thumbs up and share your thoughts in the comments section below. Returning to our previous discussion, now that we have a basic understanding of what stocks are and how they work, we can move on to the different sorts of stocks. The following are the most prevalent stock types. Income stocks. This asset generates consistent and stable income in the form of a dividend. As its name suggests, they have a low amount of volatility, according to experts, and a high dividend payout ratio. On the other hand, there are fewer investment prospects. Large, solid corporations, mainly in the real estate, natural resources, and energy industries, are good places to look for this type of stock. Low volatility, consistent dividend distribution during the last 10 to 15 years, and regular dividend increases, as well as a record of increasing profit growth, are all frequent characteristics of such securities. However, even though such equities' dividend payouts are steadily increasing, there is limited room for future growth of the money invested. Cyclical stocks. This is an equity stock that is affected by business cycles, the ups and downs of a company due to a recession or a boom in the economy. Typically, these are businesses that sell stuff such as cars, houses, and equipment, items that people buy when times are good and cut back on when times are tough. Those who buy cyclical equities during a crisis or when the price is at its lowest and sell them during an economic boom profit when the price is at its highest. However, keep in mind that in the event of a catastrophic economic downturn, these stocks may become worthless. Automobile manufacturers are an excellent illustration of cyclical stocks. Blue chip stocks. These are the stocks of huge, financially sound corporations, usually market leaders in their respective fields. Moreover, they've been around for a long time, and their market capitalization is estimated to be in the billions. All of this suggests that their stock price cannot rise significantly because it is already high. Tech stocks. These stocks logically belong to tech companies that make a variety of gadgets, devices, computers, and other equipment. Some of these businesses, such as Microsoft, are blue chip stocks. Speculative stocks. The essential word here is speculation. These are companies with little to no earnings and a high level of volatility. They are, nevertheless, potentially profitable due to their products, development into a new market, or even management changes that promise a brighter future. These stocks are exceedingly hazardous, but they also provide investors with the opportunity to earn a very large return on their investment. Part of them is called penny stocks, and it is quite popular among day traders. In addition, shares in such companies are typically offered at a very low price, which is another factor that makes them appealing. Defensive stocks. These are equities that belong to companies that have a track record of being consistent and reliable performers and being resistant to the ups and downs of the economy. They can, on the contrary, even profit during economic downturns. Growth stocks. These are corporations that dislike paying dividends to their stockholders. Rather than paying dividends to investors, they would rather reinvest in their firm and ideas. This method ensures that a company's profits and returns are higher. So, is there any danger in investing in this type of stock? There is indeed. If a company's growth goals are not met, shareholders may lose money as share values fall. That concludes today's video. Subscribe to the channel and switch on alerts to be notified of new videos. This is Flawless Finances, and we'll see you in the next video.